Steve, back to you, David Kelly. It looks like you kind of nailed it there, David. You said down to 2 cuts from 4 next year, and that seems to be exactly what they said.
Yeah, this doesn't surprise me at all. And I think what they're trying to do is lay the groundwork for being able to have, a more cautious approach to monetary easing next year. Right now there's sort of this lull between administrations. I think at some stage there's going to be some pressure on them from the administration to be more easy. So I think they're trying to sort of put a stake in the ground, saying, look, this is what you should expect from us, so they can try and avoid or postpone any fight with the administration next year or in 2026.
Stephanie, your reaction?
Yeah, I mean, rates have moved a little bit on the back of it, but the market was looking for the Fed to communicate that they're going to slow down their pace of cuts, and they certainly did that. The key thing now is that if you look on page 12 of the Summary of Economic Projections, that's where you see the risks around inflation, and now it's weighted to the upside, which last meeting it was more neutral. And then similarly on risks in terms of the unemployment rate, it was previously weighted to be a lot higher, and now it's more broadly balanced. So the shift of risks have changed notably, which is why they've slowed down they're likely to slow down their pace of cuts in the coming years.
Speak to that point, Jim Caron, about the risks on both sides of the mandate, as Steve put it.
Yeah, so look, I mean, I think that there is a component of this, which is the unemployment rate, right? So the dual mandate is full employment and stable prices. So I think what the Fed is effectively trying to do here by continuing to cut interest rates, although it's slowing its pace of cutting interest rates, is it's really trying to do a risk management exercise in the sense that it is probably more worried that you could get an accelerated rise in the unemployment rate if the Fed is too tight for too long. So I think what's behind some of the pace and the directionality of rate cuts right now is that they're trying to hedge that unemployment rate. They need to keep it around that 4.2% level. I think if it starts to rise, it has much more negative effects for the markets later on. So to me, that's a risk management exercise. That's why they're doing it. Very importantly, though, the market always thinks about these things in terms of sequencing, right? So right now, they're cutting by slower. Next thing you know, they're going to pause. And at what point then does the market maybe potentially start to price in rate hikes, even if it's for 2026? That could have more negative impacts for the market. We're not there yet. But the point, though, is that I think it's a risk management exercise for the jobs market.
David, just to go back to this kind of decision, the market's reaction is a little bit more disappointment. Maybe this was a little bit more hawkish than they expected. And even though people were expecting a hawkish cut, what do you think accounts? Is it the 2 cuts versus 4 instead of 3? What would you be watching now?
Yeah, I think we just have to read between the lines here. The Federal Reserve does not want to get in a fight with the political side of Washington on monetary policy. But if you look at their economic projections, they say, they tell you the Fed ought to take it very slowly in cutting rates from here. And I think their nightmare is that they cut too much and then economics tells them they should raise rates, and the administration is saying that they shouldn't raise rates. And, I think they value their independence. They want to be able to do this smoothly. They do not want to have to sort of fight for their independence. And so that's why I think they're very reluctant to cut too much for fear they'd have to raise rates again.
Although I'm not sure, David, how many members really want to raise rates, right? Don't you think institutionally they're biased towards more cutting? I mean, the literature says that, policy is still restrictive, and I think a lot of them are persuaded by that.
Well, we live in a world of 2 R stars. There's an R star for the economy, and inflation is likely to come down in the long run because this is not an inflation-prone economy. But if you look at financial markets, there is a lot of bubble and froth in financial markets right now. And you could argue that interest rates are not too high when it comes to financial markets. And I don't think they want to encourage any more speculation in markets right now. So I think they're trying to avoid that. And that's why they really have to think not just about the economy, but also about financial markets.